If you've been watching the US stock market lately, you've probably noticed a massive, glaring split. I mean, while the AI darlings are grabbing literally every single headline and soaring to the moon, some truly phenomenal companies have been completely left in the dust. On one side, the broader market is just riding the hype. But on the other, incredible companies are left in the shadows. But here is the secret. For the focused, long-term investor, this gap between perception and reality is exactly where the absolute best opportunities emerge. When market sentiment is incredibly low, but the underlying business remains rock solid, that's where we want to pay attention. Okay, let's dive into this. What exactly do we mean by a stock being left behind? Well, an undervalued stock is a company with strong fundamentals that is currently trading below its true intrinsic value, usually because of some temporary market pessimism. And a quick reminder before we jump in, this explainer is strictly for educational purposes, not financial advice, so always do your own research. But today, we are spotlighting robust businesses that definitely deserve a closer look. Section 1. The post-pandemic hangovers, finding value in slower growth. Kicking off our countdown at number 7, PayPal. There is a stark contrast between PayPal's current market narrative and its actual business reality. Think about it. PayPal was once one of the absolute hottest fintech stocks on the market. When digital payments exploded a few years ago, its valuation just went to the moon. Now, growth has slowed down. Competition has spiked, and investor enthusiasm has completely evaporated. People treat PayPal like a relic, entirely forgetting it's still an absolute giant. We're talking hundreds of millions of active users and enormous transaction volumes every single year. They're still generating massive cash flow, and they're aggressively buying back their own shares. Honestly, if they can just tweak their efficiency, today's valuation might look ridiculously cheap in hindsight. Moving right along to number 6 on our list. Pfizer, they are experiencing that exact same post-pandemic hangover effect. When people hear Pfizer today, they almost immediately think COVID vaccine, which was revenue that was never going to last forever, right? As those specific sales declined, the stock price took a really heavy hit. But in reality, Pfizer isn't just a pandemic stock. It is a highly resilient pharmaceutical powerhouse. They've got a remarkably diverse portfolio of essential medicines, a super deep pipeline of new drugs, and they pour billions into R&D. Plus, healthcare demand doesn't magically vanish during an economic downturn. So, with a strong dividend yield and a modest valuation right now, this is a classic value setup. Section 2. Giants under pressure. Dominant moats obscured by headlines. Coming in at number 5 on our list is a true global giant. Alphabet, the parent company of Google. Now, you might be thinking, wait, Google is undervalued? No way, it's literally one of the largest companies on earth, but size alone doesn't dictate valuation. Alphabet has absolute, undisputed leadership across online search, digital advertising, cloud computing, and yes, artificial intelligence. Recently, though, fears around AI competition and regulatory crackdowns have actually caused the stock to occasionally trade at surprisingly reasonable multiples. But what investors are missing in those flashy short-term headlines is Alphabet's incredible long-term competitive advantage and their absolute mountain of cash. If the AI revolution continues to expand, Alphabet is perfectly positioned to be one of the biggest beneficiaries, definitely not a casualty. Next up, we shift from Silicon Valley tech to traditional finance with stock number 4. Bank of America. Look, bank stocks are notoriously unpopular the very second there's a whisper of economic uncertainty. They become about as popular as a root canal. But you know what? That's exactly when Bank of America becomes undervalued. Their financial model is beautifully diversified across consumer banking, wealth management, commercial banking, and investment services. They have spent years fortifying their balance sheet and optimizing their operations. So while the headlines scream about economic turbulence, this bank remains exceptionally well capitalized. If you believe in the long-term growth of the US economy, this is a prime value opportunity just hiding in plain sight. Section 3. Bold turnaround bets. Rebuilding global dominance. Unveiling stock number 3 in this bold turnaround category, it's Disney. Disney has, admittedly, had a rough couple of years. Heavy streaming losses, shifting consumer habits, and broader economic tightening have seriously dragged down investor sentiment. But the market is temporarily forgetting their absolutely unmatched intellectual property. Marvel, Star Wars, Pixar, ESPN, and of course, those legendary cash-generating theme parks. Very few companies in human history possess a competitive moat this deep. Management is actively working right now to make streaming profitable while aggressively expanding the parks. If they can execute on this turnaround over the next few years, Disney's current valuation is going to look like an absolute steal compared to its long-term earning power. Our number 2 stock is another massive turnaround story, but this time in the critical hardware space. Intel. This is a huge turnaround story. In the past, they were the undisputed dominant force in semiconductor manufacturing globally, but they stumbled, competition intensified, and investors ruthlessly sold off the stock. But look at the present. Intel is currently right in the middle of one of the most ambitious and expensive turnaround efforts in tech history. They are investing billions to rebuild their manufacturing base for advanced chips. And in the future, global demand for semiconductors is only going in one direction thanks to AI, cloud computing, and data centers. Make no mistake, this is a higher risk play, but the market might be severely underestimating Intel's long-term recovery. If management actually pulls this strategy off, the upside is tremendous. Section 4. The ultimate value anchor. Flexibility and diversification. Taking the crown at number 1 on our list of undervalued U.S. stocks, it's Warren Buffett's powerhouse, Berkshire Hathaway. As market analysts frequently point out, Berkshire often trades below its intrinsic value simply because modern investors are obsessed with flashy short-term performance, and they completely ignore the massive value of Berkshire's underlying assets. We're talking about an unbelievably diversified enterprise, from railroads and energy to insurance and massive stock portfolios. And the true kicker, their enormous cash reserves. This unparalleled financial flexibility allows Buffett and his team to brilliantly go on a buying spree during market downturns when literally everyone else is panicking. For pure stability, quality, and long-term wealth creation, Berkshire is the absolute gold standard. Section 5. The power of patience, your long-term investing strategy. First, a crucial reality check. The market can remain pessimistic for longer than many investors expect. An undervalued stock is not a lottery ticket that's guaranteed to jump tomorrow, next week, or even next year. Managing your expectations is absolutely critical. The market is emotional, and sentiment can take a really long time to shift back to logic and fundamentals. So the crucial point is this simple 3-step mantra for successful wealth creation. Step 1, find quality companies with strong business models. Step 2, buy them at reasonable prices when the market is pessimistic or just ignoring them. And step 3, give them time to grow. Great investing isn't about chasing this week's hottest trend. It's about buying resilience on sale and letting time do the heavy lifting for your portfolio. Which brings us to you. Which of these 7 stocks, PayPal, Pfizer, Alphabet, Bank of America, Disney, Intel, or Berkshire Hathaway, do you think has the most upside potential over the next 5 years? I really want to know what you think, so drop your thoughts in the comments. If you found this explainer helpful and want more structured, deep dive learning, make sure to subscribe. Thanks so much for joining me, and I'll see you next time.